Hello, everybody. I am about to go over and give you the absolute sauce when it comes to trading. I'm going to be giving away the strategy that I use, very simplistic. And if you're a noob, you could probably understand all the concepts that I'm about to actually show you. And on top of all of that, it's going to be uncut. All right, this is going to be a full video, uncut, not edited, any of that. I can't tell you if this is going to be a 30-minute long video or a 2-hour long video. So not gonna make any promises there, but I'm gonna make it as simple and as easy for you to understand as possible with timestamps below so you can see all the different concepts and all of the different things that we're gonna go over in this video. But just laying it all out there for you guys. And if you really want to take a step further, Discord, absolutely free in the link in bio, which I live trade in every single day. You'll see my profits there, and you will see, like I said, me live trading and my live executions on that Discord. If you just tune in every single day. That's the only thing I'm really going to tell you guys. But outside of that, I don't want this to be bullshit. We're getting right into it. We're getting straight to the point. It's how I teach. And yeah, I'll show you how simple and how easy this actually is. Okay, boys. So I wanted to first start off by just kind of giving you some basic concepts, okay? Because obviously everyone's going to be in different spots. First and foremost, we're going to talk about market structure to start this off, okay? And market structure is essentially understanding if a market is bullish or understanding if a market is bearish. A bullish and bearish market, the easiest way to actually understand the differences in between them, right? For example, bullish means price is going higher, bearish means price is going lower, right? It's as simple as that. And what helps me remember this is bullish. Like if you had a bull, you know the bull would charge and continue going higher, right? It would just charge. So it's forcing price, it's charging price up. Then bearish, like a bear is kind of skittish sometimes. It'll back down a little bit, be a little bit skittish, meaning price is going to drop. So that's the easiest way, for me to understand, or how I used to be able to understand. But yeah, eventually you'll be able to understand that a lot more. And every time you hear bullish, every time you hear bearish, you know exactly what they're talking about, right? You don't have to have the analogy in your head every single time. But outside of that, I wanted to go over what makes a bullish market, what makes a bearish market. Okay, so what makes a bullish market are these, right? These are called higher highs, and these are called higher lows. Okay, as you could tell, this low here, this most recent low is going to be higher than that low. This most recent high is going to be higher than that high, right? So it's making higher highs and higher lows, forcing price to go higher. This is a bearish market, which is formed by lower lows and lower highs. Okay, as you could tell, this high here is higher than the most recent high that we made. This low here is higher than the most recent low we made. So there's going to be lower lows and lower highs because the price is trending lower, right? That's how you know if we're in a bearish or bullish market. Now there's also another market. It's called consolidation. Usually you just want to stay away from this. How you identify this is there's no higher highs being made, no higher lows being made, and vice versa. It's just nothingness. You're moving sideways. Stay away from markets at this time. The biggest and most important thing you're going to be using bullish trends versus bearish trends in market structure for is just kind of, number one, identifying your bias coming into the day, but number two, kind of understanding where market wants to go. You're going to be using this a lot more in depth when it comes to that, and obviously using your journal and all that type of stuff. So the other good thing about this is that you guys can literally go back and watch this multiple times. So let me show you guys an example. I'm trying to find a bullish versus a bearish market, right? So this is how I used to do it, and this is how I kind of train my students to do the same. So you can go back, let's say you don't have replay mode. You can go back and you can find a random high and a random low, right? So you always want to look to the left though. So if we're going to go high here, then our most recent low to the left of the chart is going to be here. So you wait until one of these get broken and closed above or below. So for example, this one gets closed below, right? That means we're going to be in a bearish market. Now you got to move this low to the most recent low to the right of the chart, which is going to be here. Then this high, he's got to go to the most recent high, right? Which this is going to stay here. Why? Because there's no highs to the left of these lows. So we're going to be in a bearish market as of right now with the new lows here, new highs here. So we're going to be bearish until we close above these highs. And as you can tell, we closed above these highs. So then you would find the next most recent high and you would move the most recent low to the right of or to the left of these highs, wherever the most recent low is, right? So you'd go right here, right? So now we're in a bullish trend, and you can just continue doing the same thing. Eventually, as you get better at it, you'll be able to just kind of, be able to tell. If you need more help with that, you can always jump in the Discord and let me know. But I just kind of wanted to give you guys basic grasps and great basic like knowledge on these things, and then put it all together. So that's going to be market structure, which that'll make more sense as we get deeper into the video. So now we're glitching on me. This is nice. Love to see this. Okay, so now okay, blah, blah, blah. Confluences is what we're coming into now. Okay, so we're going to have something called a fair value gap, which is what I use. Now, a fair value gap is pretty easy to identify. It's a 3 candlestick kind of thing that you always want to have in your mind, right? So let's say this is candlestick 1, this is candlestick 2, and this is candlestick 3. Now, candlestick 1 and candlestick 3, what they don't share is going to be that fair value gap. Okay, so for example, our fair value gap is going to be sitting from this low from candlestick 1 to this high from candlestick 3, right? Because they don't share the same actual space inside of this candle, right? So like, see how we have an opening space now here from here to here? This is going to be a fair value gap. And what you're kind of expecting is for price to, number one, either come back in and fill that. It's called an imbalance, right? And essentially what an imbalance is it's just kind of an inefficiency inside of the market that the market eventually wants to come back up and fill, or come back up and imbalance. But overall, at the end of the day, price wants to refill that bubble or that gap in the market to rebalance itself. So if essentially what a fair value gap is let's just say we come up, we fill it, we're expecting price to drop from there. Bro.
What are you doing?
Making a video.
Hey, I'm gonna run out. You need anything?
Run out to where?
Probably Farm and Fleet, and then Walmart to pick up some mulch for the yard, stuff like that.
No, I don't think so.
Yeah, Walmart, stuff like that. Okay, if you need something, let me know. Bob was home, so your car's here.
Yeah. So yes, this is what you'd be expecting. You'd be expecting price to come up, fill this imbalance, and reject it. Now, there's something called an inverse fair value gap. And essentially what that is when price closes above this imbalance, and closes, not just wicks, it closes above this imbalance, it's going to be called an inverse fair value gap, which then you're expecting price to go in that opposite direction. Okay, so you have fair value gap, you have inverse fair value gap. In fair value gap, essentially, you're respecting an imbalance. An inverse fair value gap is you are disrespecting that imbalance, and we're going to continue reversing from that direction, right? And obviously, there's different things we pair into this. It's not just as simple as that. Sometimes it really is as simple as that, but obviously, these are just called confluences inside of my strategy, which I use to obviously identify whether trade's good or not. So let me give you guys a couple of examples of fair value gaps, okay? And don't get too confused on this one, because there's something called bearish fair value gaps and bullish fair value gaps. And it's pretty simple. If it's on a green candle, if there's a fair value gap on a green candle, that's going to be a bullish fair value gap. If a fair value gap is on a red candle, that's going to be called a bearish fair value gap. And it's exactly what that sounds like, right? So if we have a fair value gap here, right? And it's very easy to spot on the chart once you really understand, right? So if we're going to go on a 3 candlestick basis, right? We're going to go candlestick 1 here, candlestick 2 here, and candlestick 3 here. Notice how we have an imbalance because we have candlestick 3, candlestick 1. Boom, imbalance. Look what happened. Bullish fair value gap because we're on a green candle. Price comes down, taps into it, rejects back higher, right? Now, what essentially happens is once we tap into, this fair value gap just gets smaller to wherever this tapped into, right? So it's still there until it gets fully filled. If price comes down, closes below, we have an inverse fair value gap, so we'd expect price to continue dropping. And then obviously we have another fair value gap sitting right here as well, right? So that's the basic, like also another bullish one, right? That's the basic kind of fundamentals of what a fair value gap is. And I want to run this very basic because people watching this video should kind of have a basic grasp of these and just kind of need like a strategy. And that's kind of what my goal is here today. But yeah, if we saw a fair value gap on red candles, it'd be a bearish fair value gap, which we have right here, right? See this red candle from here to here.
If you need anything, hit me up, bro.
Okay. But yeah, so bearish fair value up here. Notice how we came through. We did not close above, so it's not an inverse. We tap once, reject, tap another, reject, right? So these imbalances are all over the market, and that is one of my confluences that I use. Okay, next confluence. We're going to be getting into liquidity now. And essentially what liquidity is highs and lows inside of the markets, but actual wicks, highs and lows of the market. So let's say we're high right here, right? And we have a wick, and that wick has a draw on liquidity. What is a draw on liquidity? A draw on liquidity is going to be where a lot of resting orders are going to be sitting for price to potentially tap into it. Those orders get filled and we reject. Okay, and it's not just we wait for this to get hit and then we just go in the opposite direction. It's not that simple. That's why we have different confluences. But outside of that, that's really all it is. So we have a high, it gets swept, and then we're expecting a reversal off that level. And I'm going to show you a real market example of this. This is called liquidity. Let me delete all this real quick. Sorry to waste your time. Okay. Now, here's an example actually right here, right? So if we're just looking very basic, right, we see highs here, highs here, highs here. So we only have a couple of rules for this. Number one is that obviously it's a high. Number two is that if you look to the right of the chart from that high, it hasn't gotten hit before, which it hasn't because we're going to go based off of actually this high right here. So if we're completely erasing this that took it out, there's nothing that took out these highs before, right? So that's step number two. And step number three is essentially asking yourself, does it make sense that this is a draw on liquidity? Meaning, when this draw on liquidity is created, do we have a crazy reversal after making those highs? Because essentially what that's telling us is there's a ton of order sitting up here if we make highs and just spike or dump in the opposite direction, right? And so here, that is the case. We drop crazy right after making this draw on liquidity. We come back up, obviously to the right, we didn't touch it, but we come back up, we hit it. Oh, then you can see we ended up reversing off of that level. Obviously, it's not going to happen every single time, which is why we have confluences. For example, an inverse fair value gap. Look at this. So draw on liquidity, taken. We have a bullish fair value gap. So what happens when a bullish fair value gap gets inversed? It essentially means that price doesn't want to go bullish anymore. We're invalidating bullish fair value gaps. So we invalidate this one. Then obviously we just dump through here. So you're going to have a resting order sitting here still for price to come back, pull up, and fill you in. And then essentially you would go have a stop loss here. Or then you'd probably honestly just target like way down into here. But obviously this is the end of the day on a Friday, so you wouldn't probably take this trade. But at the end of the day, that's the type of trade you'd be looking for. Off of draws on liquidity, right? So you can already see how we're pairing all of this together to actually find like decent trades inside of the market, right? Where was that at? I just kind of screwed up there. But we have another confluence, and this one's going to be a little bit trickier for you guys. And I've started using it, and I just kind of want to show you guys all the possibilities we have, right? So we have something called a Fibonacci retracement. And essentially what a Fibonacci retracement is you're essentially going from high to low inside of a trend, and you're looking for retracement levels for price to come into and tap some levels, and we're expecting a complete reversal off of those levels to take a different draw on liquidity, to take into a fair value gap, whatever it is. That's what we are looking for this. And instead of me trying to explain it to you, I'm just going to show it to you, because I know a lot of you guys are a lot more visual learners than anything else. So I know that this has actually played out a ton this week, so I'm actually going to show you guys that. Let me go. I remember there was one, I believe, on Thursday. Yes, there was. Okay, so what price is right now, I'm not going to look for fair value gaps. I'm not going to look for anything because I just wanted to show you this, because obviously you pair it with fair value gaps and all that. But at the end of the day, let me just show you this. So fib retracement, you measure the whole leg. So if we look at this 1 minute, you can see the top of the leg here, bottom of the leg here. Don't acknowledge this just chop, right? This is just one big extension leg, how we're looking at it. So if you measure from low to high of that wick, so I'm going from this high to this low, and then we extend this out, the main levels you want to look for is the 0.705, the 0.79, and the 0.62. And essentially what the biggest level is the 0.79. So if you wanted to take a trade off of a level, you always want to go stop loss below that 0.79, because if we're going to continue extending through, we're probably going to take this draw on liquidity, right? The 0.79 is our last line of defense. So what you can do is, and what a lot of people do, is put limit orders. So you could put a limit order here at 0.75 and wait for price to hit it, and it'll automatically put you in at buys. But usually if you're gonna have a limit order here, you're gonna put your stop loss below this 0.79 level, right? Or you can just wait for the best level, wait for 0.79, and this is exactly how you can top and bottom tick off of specific levels, and you can literally just target those most recent highs off of that extension leg. And that is literally a 1 to 12 off of absolutely bottom ticking, one of the most crazy devious things of all time, right? And literally all you have to do is measure from high to low. Mathematics are just in the way. All you have to know is your last line of defense is 0.79. So if we're going to deliver, we're going to deliver from there. Then obviously you can go a little bit more safe with your stop loss and still get it like a 1 to 3, which is a crazy good risk to reward. But this is how people bottom and top tick, and this is a very big confluence that I also use, because if we have confluences stacked with this, the trade's probably going to play out, right? So that is the final confluence. We have fair value gaps, we have inverse fair value gaps, we have draws on liquidity, we have Fibonacci retracement, and I don't think I'm missing anything else. Then obviously we have market direction. So the very first thing I was talking about, obviously that is also kind of like a confluence I use as well inside of my trading to make rational decisions inside of the markets. So now that you guys have seen all the confluences, I gave you examples of all the confluences. Now we're going to go into tying this all together and showing you exactly how you can place trades basically based off of this. So let me delete all of this stuff. Oh wait, no, I can't delete all this because I have to journal that. Actually, yeah, okay, so I'm going to tap into this, guys. I'm going to show you what I was looking for on Friday, because that's going to be like a really good example for you guys, so you can see how I tied everything together to make a rational decision. So now we're going to kind of go into like time frames, okay? So every single day when I'm going into the markets, I look for draws on liquidity first, okay? And you guys got to write this shit down, because I'm not going to sit here and repeat myself. But I'm gonna tell you exactly the step-by-step process. Take notes right the fuck now if you want to lock in on this, okay? Because it's gonna take a while for you to actually be able to follow this, because it's just not a lot of steps, but a lot of people actually like confuse this up. So write this entire thing down. This is literally gonna be step-by-step what I do every single morning before market open, or then going into market open, what I look for, what I do, and I'm running you guys down the basics here, guys. I'm literally speed running my strategy right now. So, first and foremost, I start on the 30-minute time frame coming into market open, okay? So we're going to pretend like it's Friday. Okay, so 9:30, right? This is also OPEX. 9:30, what are we doing? We're looking for draws on liquidity. We're starting at the 30-minute time frame, okay? So what's draws on liquidity? Just simply highs and lows that we react with, and nothing has touched it yet to the right of the chart. So what do we see here? Draw on liquidity. We have that low. Price clearly moved higher to the right of the chart. Didn't get hit yet. Same here. We have a low. Price moved from it to the right of the chart. Haven't gotten hit yet. And obviously liquidity here. But we're not going to just keep marking that, because look how far away price is from that. So I just mark here. Or relatively close to price. As price comes down and let's say taps into this, and we're invalidating these and continue going lower or whatever, then I'll go back and make sure I know these are here as well, right? But I'm not gonna mark unnecessary shit. It's always relatively close to what price is, okay? Because we do this every day. Now, after doing that, I look for fair value gaps, okay? Now, right here, we have a 30-minute fair value gap here, 30-minute here. You know, we have a lot of imbalances. 30 minutes sitting here. Okay, and then after that, obviously I'll mark it, make sure I know it's there. I'll go to the 1 hour time frame. I'll look for the same shit, right? Obviously we're gonna have we're gonna have a 1 hour draw on liquidity here, which is already marked on the 30-minute. Majority of the time it will be. But now on the higher time frames, we're just kind of looking for fair value gaps. I don't really care about draws on liquidity unless it's like all-time highs or anything like that. So now on the 2 hour, we know we have a fair value gap here, so you can mark that 2 hour fair value gap there, because we just got to know that it's there, right? 4 hours sitting here, which is kind of the same as the 2 hour. Now, we can go to the daily and just take a glance at it. Nothing too crazy. We know we have fair value gaps down here, but the bigger and more important part is that we're getting close to all-time highs, right? Which we already took it, but that's besides the point. We're getting close to all-time highs. So you're only gonna be wanting to look for buys on this day. Okay, because all-time highs are right here. You want to look for buys on this day, guys. Stop trying to short when we are this close to all-time highs. It makes no sense, right? Because also what we're doing on these higher time frames is understanding, are we bullish or bearish? And if any of you say bearish here, you have an issue. All you have to do is see that we're clearly going higher. I just showed you previously how to find bullish versus bearish markets. You don't even have to try here. We are clearly bullish on all time frames, like daily just going higher, 4 hour just going higher, 2 hour just going higher, 1 hour just going higher. How could you possibly think this is bearish? Stop trying to catch reversals. Stop trying to reverse on the market. Guys, when market is clearly going higher, you trying to take shorts is you trying to predict a pullback. That is a crazy prediction to try to make. So please stop trying to do that. It's going to piss me off. You look where market wants to go and you make a rational decision. Friday, perfect ass setup, right? I went break even on the trade, but A plus setup. Like I said, OPEX day. I probably shouldn't have been as aggressive as I was, but it was a perfect A plus setup and I'm okay with going break even on it. And this is a perfect day and perfect trade to show you guys exactly deeper into my strategy. So that's besides the point. So we know we have 30-minute for value gaps. We know higher time frames are clearly bullish. So we're looking for buys. Overall, we want to see these all-time highs get hit, okay? So 30-minute draw or 30-minute fair value gap is going to be getting tapped into here at market open, which is also 15-minute. You just kind of got to know this, that you have staggered fair value gaps, right? You have another 5-minute fair value gap right here, and it's 30-minute, it's 15-minute. We're staggered. This is going to be pretty strong. So we low-key want to find some sort of a buy. So now we have draws and liquidity marked. We know where our fair value gaps are. We know we're super bullish on the day. What are we doing now? We're going to go to the smaller time frames. Now, I'm talking 5-minute, I'm talking 2-minute, I'm talking 1 minute, I'm talking 3-minute, I'm talking, 4-minute, whatever, right? Smaller time frames. So we know this 5-minute is here. Now, what do I want to see for price to go higher? Okay, now that is what I'm thinking of coming into the market. Price is clearly dropping. What do I want to see if I want to see buys out of this level? Okay, or out of this place. What I want to see is, number one, either us respecting this fair value gap and probably coming down and taking out low resistance liquidity. What's low resistance liquidity? That's going to be 1 minute, 2-minute, 5-minute draws on liquidity. Anything below the 30-minute time frame is going to be low resistance draw on liquidity. So this is perfect when you actually tie it up with like higher time frame biases or higher time frame PD arrays, as some will call it, higher time frame fair value gaps. Okay, so we're in a 30-minute fair value gap, we're in a 5-minute fair value gap, we're in a 15-minute fair value gap. So what do? We pair that with a smaller time frame draw on liquidity that gets created, so then we can support our idea of trying to go long. Okay, so or we can see low resistance draw on liquidity like down here, come down, get swept, and then see a reversal from there. But honestly, it's A plus when we see a high time frame fair value gap with a low time frame draw on liquidity, then low time frame, inverse fair value gap out of that. Like, that is so many stacked shit on top of each other. Like, that's A fucking plus, and you're gonna see what ended up happening today. So, or on this day. So I ended up being super patient, which, hold on, my thing sometimes twitches like that. Okay, so I was like really patient coming into this day, and I just wanted to see what I wanted to see. So let's keep waiting here and see what ends up happening, right? So we come down, we're still in this 30 minutes, so we're just kind of sitting here and being patient. We're just kind of sitting here waiting, right? We're just waiting, keep waiting. Nothing good enough, right? I'm not just going to take longs here. Like, oh my God, price is going higher. I'm going to take a long. Let me long. Like, no, shut the fuck up. You wait. You stay patient. You wait. What time frame is this fair value gap? 15-minute, 30-minute fair value gap. Okay, so what does that mean? That means that all we have to do is sit here and wait, because we can see remanipulation at these lows now, right? This low resistance draw on liquidity was now just created, okay? And now that it was just created, now we have time to re-sweep that and then deliver. We're not actually going to take a long off of this level unless this 5-minute inverse fair value gap gets inversed. And this is actually what I was looking for. So because we're clearly wanting to go higher. We're clearly just coming down to fill this 30-minute. If this 5-minute fair value gap gets inverse, so we close above, I'm taking longs up into these highs, or I'm taking longs up into all-time highs, right? Because I was very, very bullish on the day. That's what I wanted to see. But we ended up not inversing that. Sorry to spoil it. But let's see here. Let's keep playing this out here, because that is another level, right? Because we're rejecting off of a 30-minute, we're rejecting off of a 15-minute fair value gap. Now we just want to see like a 3-minute, a 2-minute, a 5-minute fair value gap get inverse, and then I want to see this continue pushing higher. That's overall what my look was, right? But we didn't get that, so I scratched it, right? I'm not trying to jump in a trade, I'm just scratching it. So price is going to start dropping a little bit off. Okay, here we go. Now we get price dropping off. I forgot to mention this confluence. This is called an SMT. So you know you have MNQ here, and then there's MES. Those are the only two things I trade. I only execute on NQ. But an SMT is when a draw on liquidity gets taken out, let's say, for example, on ES, but not on NQ, it's going to form an SMT. And essentially what that's going to do, or what that's doing, is it's pretending that this draw on liquidity essentially got taken out on NQ. Because if we go over to ES, look at, these are the same exact lows we're looking at, right? And notice how they got taken out on ES, but not on NQ. So that forms an SMT here. So we're just assuming that at this price point, we took out this draw on liquidity on NQ. So now what are we doing? We're waiting for our entry confluence, which is this 1-minute inverse. This is perfect, right? And I go break even at highs. So I see a lot of people take this trade in specific and just aim for these highs. So that was actually a really good trade, because if they just took it off the 1-minute, aimed for the highs, and just did some super risky stop loss, I mean, it's still a really good base hit trade on a very risky type of day in terms of, you know, options stuff expiring. But this is the trade I was looking for. I wanted this 1-minute inverse. I obviously entered off of it because we're going to end up inversing. And then I was targeting these highs because that was a 1 to 2.6. So that's already what I was targeting coming into this day. Just look how perfect that is, right? Now, what do we end up doing? Let's see. We come up, tap that break even, boom. So those people who did riskier stop losses would have smoked TP. Good for them. Now, I entered there. Obviously, this is my break even. So what's going to end up happening? It's going to come right back down and stop me out at break even. And why is this? It's because of the slow price action we got in the beginning of the day. We rejected off this 5-minute too. So I was like, yeah, might as well go break even. It is what it is. And at the end of the day, we did end up coming all the way back up. Look how slow we are moving. But we ended up coming right back up and took out all of my draws on liquidity coming into the day. So I showed you guys exactly how I find my draws on liquidity, right? So all-time highs is obviously a huge draw on liquidity that you're expecting price to run to. Obviously, we were bullish on all time frames. Why would you try to short this market? It makes no sense. Only look for buys. And I showed you an exact example of how you can use these confluences to your favor to place rational decisions inside of the market. Like I said, I'm not a sugarcoater. I hate like, oh, I'm going to try to make a 3-hour or 4-hour video on blah, blah, blah for absolutely no reason, right? I'm just here to show you guys the confluences. I'm here to show you examples. I'm here to show you exactly what a perfect setup and exactly what a perfect trade looks like. And you can just copy it. You can just literally do this because this shit applies or comes into the market all the time. It's not difficult. Okay, so now I wanted to also show you guys something else. What was it? Hold on. I believe. Give me this. I wanted to see this extension level. See where we were at in this specific time. Give me a second. Bro. Get right here. Okay. Yeah, this extension level obviously nothing happen, but that's an exact trade. I showed you the extension or the Fibonacci retracement anyways. If you guys have any questions, please let me know. I just wanted to give you guys all the confluences. I wanted to give you guys all examples of the confluences. Then I want to give you an example of a trade setup, and then exactly walk through. So all you had to do was take notes there and just go back. I want to challenge you guys, go back and practice doing this, back test, do whatever you want to do. And if you guys have any examples or anything you actually want me to show you more about the strategy or go deeper into, I'm 110% down for that. But like I said, I didn't want to sugarcoat things. I just want to give you guys straight to the point. You can literally go back, watch any point of the video you want again. And yeah, that's the good point of me kind of going, not necessarily speed running it, but just kind of doing it so you guys can just get the basic concept, get exactly what a good setup looks like, get exactly what all the confluences are, what the confluences look like in real action, and just kind of comparing the two, not sugarcoating shit, not extending this, making it longer than it needs to be, just short, sweet, simple, and that's how you learn how to day trade. Short, sweet, simple, clear mind, clean life, clean eating, clean everything, and this shit works. So that's it. If you guys have any questions, anything you want me to go deeper into, please leave it in the comments below. I will make sure I get to it. I love you guys so much. Thank you so much for the support, and let's lock in this next week. And at the end of the day, join the free Discord to see how I continue to improve week over week live executing. I'll talk to you guys soon. Peace out.